compression, that the battery lasts for 2 hours. Welcome in class 6, lecture 6, and lecture number 5, the planned but cancelled guest lecture will take place in week 8. So week 5 is week 8, meaning that the planned topic of week 8 will be dropped of the course expectation landscape. That is not to say that it is uninteresting, chapter 8, but learning is a flexible thing, and the key learning objective is to get a gist of corporate law presented in the way by the Kraakman team in terms of the huge table. Today, 3 topics: the establishment, the bankruptcy, and the creditors. And in terms of the grand table of all the topics of the course, we are dwelling today on 3 categories of events in the life of a firm, a undertaking, a business. And they are interconnected, and they are partly already mentioned in earlier instances. So today should be seen as a sort of closure where it comes to these themes, and as a tool to discuss those legal strategies. So step 1 is to look at establishment and bankruptcy from a business law perspective. In my definition of business law, that is the don't use your brain too much approach to law. That is, just read what it takes to establish a corporation and get it done. Which, for a certain level of thinking, is enough. This course is more intellectually oriented. So with each of those quick and dirty rules pertaining to establishment or bankruptcy, we ask the question, why are these rules there? And how could we classify these rules? Because your life is not about following rules, but breaking rules and changing rules. To apply that on your own life, when the course description says 2,000 words, your task is to break that rule, because it's your paper, not my paper. And then let's exercise how you can do the thing of breaking rules and getting away with it. And then not to break rules to make the world uglier, but to break rules to make the world a little bit nicer. When or why? When those rules are obstructing you in making the world a little bit nicer. Okay. So that is one of the many perspectives you can have on the rules. And I repeat them because in introductory remarks in an exam or in your future career, it is helpful to share these perspectives with your audience. So if you have a busy entrepreneur with just a brain dead question, get me a legal person, don't bother that client with reflection on affiliation strategies, stuff like that. Just tell them how it works. But most of your clients, they don't know whether they need a legal person. The only thing they know is, I want return on investment. There you go. Here are the options. One option is establishing a firm. So that is the context. Let's look at the topic more closely. I embraced once in a while the term of a life cycle approach to an issue. And the establishment and bankruptcy theme are the typical example of a life cycle approach, because establishment equals birth and bankruptcy equals death. How much life cycle can you get? And so that is just to make that explicit. And a life cycle approach is nothing more than just an attempt to bring it systematically to you. And my hope is that you follow that example in your career. So when your boss asks you to present something, think of a logical order of things. And most of the cases, a alphabetical order of topics is not the most logical. Because then you start with bankruptcy, with B, and you follow up with the E of establishment, which is not necessarily the way how clients wants to do their entrepreneurial life, to start with a bankruptcy and then establishing the thing, which is sort of tough to do, if not impossible. So it's nothing magic, it's just a form of logic, and then with a marketing tool. You know, the word life cycle is a little bit absurd, you know. We're in a serious degree and you start to talk about life cycle. That is just rhetorics to draw your attention. And I invite you to do the same. Because there are many of you, and please, in recruitment phases, draw their attention with, you know, metaphors, words, which have a certain purpose and can be defined. So, and last but not least, today we will talk about creditors. And creditors are also a theme that are intertwined and connected to all the other themes. So each time creditors pop up, and today has the purpose to have a sort of more systematic half an hour on creditors, so that we are on one page when it comes to the exam, and maybe one question is on creditors, and then we have a sort of consolidation of the topic. So, two leading questions. So, in a certain sense, how does it work? Sort of business school approach. And secondly, what are the principles and strategies? So that is today. Well, let's start then with topic one of today, the establishment. And then establishment is about terminology and the principal agents issue and asset partition. So these are the key words that we will touch upon right now. Maybe first the terminology. So establishment is a synonym of the creation or the founding of a legal person, or the creation of a legal person, all synonyms. And the most boring but legally most relevant synonym is to register a legal person. Because in law, everything that is registered really exists. And if things, including human beings, are not registered, you have a problem, you know. Undocumented people, you know, headache, stuff like that. And so those are all synonyms. Then secondly, the critical issue is, when is the activity of establishment completed and when is it not completed? So when there are certain rules, hopefully quick and dirty rules, on the establishment, and then from a lawyer's perspective, a sort of critical issue is, did the human activity succeed in the desired outcome, being a legal person? Or did someone in the process something wrong, which is the theme of lawyers? Did something go wrong? And then you try to point at the thing that went wrong, etc. So 99.9 of all the establishment activities are successful because you don't need a degree to establish a firm. Even more, or moreover, there is a interests of states to get as much or as many corporate citizens as possible, because that is connected with boosting your economy, creating a business-friendly environment, because legal persons are the metaphor or the promise for employment and, you know, profit, tax, income, etc., etc. So on the side of states, where it comes to the quick and dirty rules of the establishment as such, there is a sort of competition who is creating the most easy administrative environment to do the thing, to do the trick of the establishment. And then the most extreme version is, I believe, Georgia, where on the airport there is a booth after the immigration, you know, you show your passport, and in that booth a entrepreneur can establish a legal person in 1 hour. That means that all the legislative nitty-gritty of a jurisdiction is channeled in such a way that all the necessary steps can be done in an official way and in an effective way in that one booth operated by the relevant state representatives who are by law required to do the trick. So, and there are sort of rankings, and I don't know whether Georgia is still at the top of that ranking, because if you can do it in 1 hour, maybe in Dubai you can do it in 3/4 of an hour, and maybe ministries of economic affairs somewhere on the globe are sitting in meetings with graduates of this type of program to see whether you can do it in half an hour, you know? Whatever. If that makes you happy as legal system. In reality, in the more old-fashioned jurisdictions, in the UK, in even Delaware, in the Netherlands, it takes you 2 weeks. Because there is another thing called money laundering and financing of terrorism, with international treaties obliging states to check entrepreneurs prior to offering them facilities. And that requires, you know, paperwork, and that you have to disclose yourself and to tell the authorities what the sources of your finance, etc., etc. But I park it. That's for the ID, not important. The critical issue here is, how do you get such a thing launched, thing as a legal person, and that in the most extreme facilitated version can be done in 1 hour. Let's take the next step in thinking and look at a theoretical theme called asset partitioning. Because the whole idea of a legal person is to have some assets, because with assets, in the broad sense of the word, you can realize return on investment in the abstract. And then, as you know from your paper, from analyzing a multinational enterprise, they have multiple legal persons, and asset partitioning is the question, which legal person has which assets. And there's a direct link with bankruptcy law, because if a legal person goes bankrupt, the assets of that legal person are at stake, not the assets of another legal person. So, the critical question as of the establishment or during the establishment is, do I actually want to put my assets in this legal person? Or do I create two legal persons in that 1 hour? One with assets and one without assets. And surprise, surprise, if you make such a choice, then obviously the legal person without assets is then the economic active legal person. You know, they are then entering into the selling products and services to clients business, and if something goes wrong, they say, oh, we are empty. And then the other legal person has the assets, but not the contract. That is the most baseline theme you have to think of in the abstract topic of asset partition. To trick your creditor, basically. Okay, so that's sort of grim lawyer's approach. Obviously, there are more positive-oriented economic considerations of efficiency and managerial control, governance, ideas on who's managing which assets, etc. So there's obviously a positive side. But with apologies, lawyers, especially in this week where bankruptcy is sort of coming to a closure, and we look at these things from a sort of negative perspective. So what happens if there are no assets? Okay. That's the bottom line. Let's now move to the more systematic approach of the theme asset partitioning. And, and that systematic approach is, what are, in the first place, the options? Where could I put my assets? And in that option line, it is about that the founder can continue to be the owner of the assets. Let's say that you have a magical machine, and that magical machine can produce magical product Y. And the machine is owned by a human being called founder, and that human being decides to create a legal person, but not to give the magical machine to the legal person. Then the legal person could start selling product Y to the audience, to the public in Georgia. The moment there is actually a customer in demand of product I, then the legal person can purchase the product from the founder. So, in a drawing, if we have a founder over here, the proud owner of a machine, the machine X, then you have the legal person, then you have the customer, product I, then the founder, who happens to be the director, can sell product I, and the moment that it is sold, he purchases it from himself, the founder. So, an empty legal person, here's the asset, still with the founder, and here are the customers, and no one knows. And so, here the legal person is an intermediary between the human being and the market. There's no law on the globe that obliges you as a founder to put your magical machine in the legal person. That is a decision. So what is the bottom line? The bottom line is that each little step comes with the choices, and unless law obliges you to a certain choice, the choices are up to you. And then there's a question. May I ask you to share your question with us because if one student has a question, then maybe, and my answer can illuminate the thing.
Yeah, I was just wondering why wouldn't you put the asset directly in your corporation?
So the question is, why would you not put the asset in the legal person?
Yeah.
Well, let's start with the opening statement. Normally speaking, the whole idea is that you put the asset in the legal person because then it can grow. But founders or holding companies, because the founder could also be Unilever Holding, they are emotional beings. And they can have a sort of feeling, I don't like my magical machine in that legal person. So here we see, and this happens quite a lot, here we see the clash between logic and how actors in this field actually operate. And I want to share that with you. One, to give you a little insight in the bizarre world where you start working in 50 Man. And two, that all these steps are based on choices and sort of deliberation. And this is sort of the most extreme. You could ask a mirror question, why on earth establish a legal person if you don't want to put the asset in the legal person? Well, that is because the same emotion says, well, I heard in class that being a sole proprietorship is not a cool thing. Because if the customer has a complaint, they only can call the legal person, not the human being. There's no contract with the human being. Funny, isn't it? This you miss if you think in business law, tell me what I need to do. Because then people say, well, you establish a legal person and you put your assets in it because that's the logical thing to do. Logic for who? Let's move to founders of creative businesses. Rolling Stones. They're not putting themselves in the legal person. They put a license to their song in the legal person. Because their tax advisor said, well, that's tax-wise is a clever thing to do. But they continue to be human beings with a voice, running around, you know, artists. They're difficult to put in a legal person. And so this is step one. Why? To systematically follow a list where to put the asset. Step one. Step two. You could say a bank, you know, is offering the critical loan to the newly established operation firm, but through the mechanism of security, so this is the plant, and then through the concept of security, so mortgage, lien, attachment, the value of this whole plant is basically given to the bank. If you then ask from a substantive point of view, does this legal person fully owns a plant, an asset? The deeper answer is no, because it's owned by the bank. Well, this is a controversial thing to say, because lawyers, and there's sort of scheme around it, because formally speaking, the owner of the plant is the legal person in this drawing. And only when the firm, the legal person, is in default, the bank gets the building. But the critical thing is, that mortgage right has a sort of Harry Potter protective shield type of effect. No one else can do whatever with the building. You cannot lease it out without the bank's permission. All the other creditors cannot touch it. The trustee cannot touch it. No one can touch it. So, option number 2 in creating a firm is to allow a bank to be your debt financer. We know that term already. So on the balance sheet, it's still there, you know, the debt financer on the right lower corner and the assets on the upper corner. But through this trick of security, you can do this. Security can also be understood in the more stock market trades place. So the stock market, where you have securities, because you can trade with the security on a higher level. So all the mortgages of American house owners in a bundle, and you can trade that bundle, stuff like that. This is a very common way of putting assets in a firm. And in the story of today, we connect that with the establishment phase, because that is the most clear. Because then legal person is empty, and then somewhere you need a building. Obviously, also firms that exist for 100 years can do the same. So there's a repetitive mechanism around assets. The third option pertaining to assets is the creditor. So creditors will be called after the break with names like supplier and stuff like that. So as a creditor, you could supply, let's say, raw material. This is a Y accent. And then legal systems allow for a sale and purchase contract of Y accent, so raw material or whatever, with the retention of title. Think of Michael Milo, previous course. Then you hand over the objects, Y accent, but you continue to be owner of the thing until the moment they pay the bill. Retention of title. So, if you then visit the undertaking, you see a building, you see raw material, and you think, as a potential investor or creditor, whoa, cool firm. All kinds of concrete assets. So let's affiliate myself with it, because if something goes wrong, my debt, my claim can be recovered on those assets. Legal answer? No way. The building is from the bank and the raw material is from the creditor. So here we see a combination of plain, simple private law and corporate law in a combination. Because a bank loan is just a contract. Here's the money, promise to give it back. That's all. Supplier is just simple contract law. Here is raw material and please pay. Nothing special. Like buying cappuccino. But with those additions of private law, called securities, mortgage, called retention of title, all and a sudden, in the theme of asset partitioning, or which assets does a firm has, it gets a deeper sort of meaning and option 4. Let's create a additional legal person to put the assets in. legal person number 2. And if you establish 2 legal persons, then most likely you first create a mother company, a holding company. Because who is then managing the shares of those 2 legal persons? Well, the founder, that's a human being. Human beings can die, that's inconvenient. So let's replace the human being with a legal person called holding company, mother company, headquarter type of thingy. And then you can have all those arrangements with assets in this asset company, you know, with managers and graduates like you who are fluent in asset management. And then this one is then dealing with customers, you know, with different type of graduates of this School of Economics who are, you know, fluent in marketing, in product development and stuff like that. And here the word partitioning comes up. So there are various reasons, emotional reasons, accounting reasons, human resource reasons, to partition in a group of companies the ownership of assets in one and other activities in the other. For instance, if that other is supposed to be present in markets in Brazil, in China, in Samoa Islands, in the Netherlands, where they all require quite often that the moment you are engaging with customers, consumers, that you have a local establishment. And most undertakings have a very simple structure because they only need one plant. You know, Apple needs one plant in China to make all the iPhones. You don't need the plant in the Netherlands. So they have, in terms of asset partitioning, one plant in China, and then all the other legal persons basically have no assets. They just are sales channels in marketing terms. And that is what partitioning means. Partitioning is just a verb to deliberately put assets in one legal person or another legal person and not in others. That's all. Well, and then let's move to legal strategies, so regulatory strategies, the strategies of a legal system to protect principles from the doings of agents. Who are the principals and who are the agents? So customers are potentially same as creditors, and creditors are principals, and then the firm is the agent. That's one of those views we adopted in this court. How could you then protect that principle where the legal person is empty? And the first strategy is then the affiliation strategy. Let's forget about consumers because that is difficult. Because consumers do not do the affiliation due diligence. Do I want to purchase from Apple? There you have other consumer law with guarantees and product liability and stuff like that. Let's move to individual creditors, bigger creditors, who have the brain power or the advisory power to do a due diligence, in the broad sense of the word, the affiliation choice trick. Well, and that is then why we have these annual statements, and in all the jurisdiction the obligation to put the annual statements in the register on a yearly basis. And last week we already heard that there's personal liability of a director in a bankruptcy situation when he did not publish the annual statement, remember? And on the financial statement of that particular legal person in the Philippines, on the left side you don't see assets, and then you tell the contract party, well, I wish to provide you with raw material or whatever, but you're an empty legal person. And then something magical happens. It's not that people are not willing to interact. No, they want to interact because they want to sell their raw material or their services or their whatever. And the solution is called a guarantee. So if you are a creditor here in the Samoa Islands, KPMG Samoa, offering bookkeeping services to the legal person, then there's a little letter of another legal person in the group of company. Simple email, a guarantee. If your bill, if your invoice is not paid, then we will pay on behalf of our daughter company. So, start with assets. And the thinking, an asset represents the recovery of a disappointed creditor. Step 2 is, most of the legal persons on the globe are empty, because they are vehicles for a certain purpose. Step 3 is, you still want to contract with these empty legal persons, because they represent Coca-Cola worldwide, you know. But they need, you know, bookkeeping in the Samoa Islands, and there's a KPMG office, you know, people like you, on a expat contract, and you want to be paid, and it's a very simple solution in step 4, that someone else, as in legal person, in the group of companies, provides you with a guarantee or equivalent in the local language. So here you see why asset partitioning is a sort of relevant thing in the perspective of affiliation. And then there's a other strategy called the rule strategy, and that is the idea that each legal person has some sort of minimum capital. But there is something rotten with the concept of minimal capital. Because, what's the whole purpose of capital? That you translate money to a machine and then start producing, you know, ice cubes, or CDs or DVDs. So there's no jurisdiction that says that you have to keep cash on your bank account. That's a stupid thing, you know. On cash you have to pay interest with the central bank. So capital is not cash, is, okay, there should be a minimum of assets. And that can be a machine to produce DVD, but then a stupid person invented Spotify, and no one buys DVDs anymore, or Netflix, you know. Do you buy DVDs? No. There are quite a few machines out there in the world. Translated or transformed capital into a machine. With a lot of dust on the machine. But still on the balance sheet. You know, Philips, DVD, NV, proud owner of a DVD machine. With dust. So the thing with capital requirements is that on day 1 it's cool. You know, 18,000, 40,000, 100,000, I don't care. And on day 1, it's a rich legal entity, let's make a deal with it, you know, in terms of providing services, goods, stuff like that. But that minimum capital is never enough to purchase all the buildings and stuff like that. I mean, 18,000 euro, for you it's sort of money as a student, but it's nothing, you know, or 40,000 or 100,000. Nothing. When you talk about serious enterprises, 100,000 euro, nothing. So these requirements are sort of nothingness in the first place. And secondly, on day 2, there's a machine with potentially dust. And then 2 things happen. Certain jurisdictions sharpen and innovate on these rules. Germany, the Netherlands a little bit. And they say, well, but then the machine should be appreciated by a conveyor. And then if there's dust on it, you have to buy another machine. And sort of dust control. And then the true value should be disclosed. And if that goes below a certain level, you are not allowed to take money out of the company or all kinds of other legal consequences. And that's a very tough road. It's a religious road where there's no solution. Because companies are much clever, more clever than these legislative sort of initiatives. And the other thing that happens is that jurisdiction says, forget about the minimum capital. Here's your legal entity with €1. If you want an empty legal person, who are we legislators to obstruct you? And statistically, that's sort of the majority of jurisdictions embracing forgetting about the minimum capital. Because in terms of transaction costs, in terms of real effects, it's not proven to be effective. But for religious reasons, certain jurisdictions do not want to give it. And they say, well, but stock market listed companies should at least have a minimum capital of, 200,000, 500,000. But if you look at the balance sheet of Shell, it's $600 billion. So why bother about sort of fine-tuned legislation, whether it is 100,000, 200,000, blah, blah, blah. So that is sort of the dynamic when it comes to the rule-based approach. If you want a legal person, you need a starting capital. Question?
No, it's
Solved already? Cool. So this is ownership of assets around the establishment phase, with 2 reflections: affiliation strategy, rule-based strategy. Let's move to the theme or the phase during ordinary existence or ordinary management. And then basically you have the same option, but the most dominant ones are that the legal person owns the assets, or that the creditors, the banks and the suppliers own the creditors. So in the ordinary course of business, firms that already exist for 100 years, there's no founder with assets, they're gone, they're dead. So then you just have the legal person with the assets, or the creditors, the banks, the suppliers, who are the ultimate beneficiary of the assets. Let's put it that way. And then obviously a very exciting phase of a legal person is the bankruptcy, so the liquidation, the death metaphorically. And then we have 2 strategies. One is the rule strategies, bankruptcy law that says very explicitly who are entitled to the assets. First, the trustee. Secondly, the tax authority. And then the real assets, as in buildings, are going to the banks, and the raw material to the creditors. And that's then basically sort of the baseline framework of a rule strategy pertaining to assets. So so please realize that then the bankruptcy laws just explicitly state who is entitled to which asset in terms of percentage. And so that's very concrete. And then the standards strategy, this exposed reviewing of the performance of most dominantly the directors, the board, is then, and we discussed it last week, but let's repeat it, a strategy to review the performance of the board in hindsight and point at certain types of behavior that is regarded as not in line with the duty of care, with the consequence that the private property of the directors, the board members, is then channeled to the estate, the bankrupt estate, and benefiting other creditors. So, first of all, we identify the phase of the assets. So this is the story of the life of an enterprise from the point of view of its assets. And then in the life cycle at the end, there's this thing rounding up, bankruptcy, liquidation. What will happen with the asset? We identify the rule strategy where the laws, bankruptcy laws, explicit on tax authorities come first, as an example. And the standard strategy is basically a tool to increase the assets of the estate, of the bankrupt legal person, by adding the assets of the private assets of the directors who stepped outside the line of duty of care. With, last week, this quick and dirty example of a assumed malpractice being not publishing your financial statement, which is then assumed to be a cause of the bankruptcy. So there you have the sort of X-ray from an enterprise, from the asset perspective. And assets, symbolically, to conclude with, as the object of recourse. Oh, here are some drawings. So this is the private home of the owner, founder, and here this angle represents that it is owned by the legal person, and this is then a creditor. So the green line is the primary relationship, you know, KPMG, Shell, they offer services or supply products or whatever. And then in distress, so this is an advance on the second topic, bankruptcy. In distress, this line is cut through, and this line is cut through, and the creditors are ultimately satisfying their claim on the assets. So normally there's this green line, normal course of business, you get paid, you send the invoice, you get paid, cash. That's how it should be. 99% of all the transactions on the globe are green. Assets do not play a role. Just in the extreme situation of the death, bankruptcy, liquidation, then all and a sudden the red line establishes a relationship between the creditors and the assets formerly owned by the firm. So just angles for those with visual memory type of learning styles. And then last but not least, there are, in terms of these quick and dirty rules, sort of 3 things you have to remember in the particular establishment moment of time. And that is 1, there should be a establishment act, a deed, a piece of paper that says herewith a legal person is established. Remember, a legal person was a fictitious thingy. And the most concrete sort of proof of the creation is a piece of paper with ink. And then depending on the state you're in, with all kinds of stamps and color and flags. But the wording is the same all over the world. Herewith it is established a legal person with the name blah blah blah. So that's one. Two, each legal person in all the jurisdictions we discuss needs to have a minimum in terms of a articles of incorporation. A sort of set of house rules that determines the operation of that particular legal person, to avoid that all the stakeholders need to consult the law in terms of their rights, you know, appointment of a board and when and stuff like that. So to make life easy, law says, and to lower transaction costs, the law says, please create articles of incorporation. So there you have two documents already. The deed establishing and the articles of incorporation. Two documents is inefficient, so they are put together. So the first page of the Establishment Act in the Netherlands, in Germany, for instance, is herewith the legal person is established, and then halfway the first page it says, and this legal person has the following articles of incorporation, colon, Article 1, Article 2, Article 3. But those are conceptually two different things. So the Establishing Act, in certain jurisdictions, for instance in the United States, the Establishment Act has these sort of curved lines, and you can frame it and put it on your wall. You know? Go to a snack bar, kebab firm somewhere in Istanbul or New York, and you see on the wall the sort of act of establishment, sort of birth certificate thing. But for the stakeholders, the articles of incorporation are very important. And thirdly, each legal person on the globe needs, one way or the other, a register of the shareholders. Because somewhere it should be noted who the owners are. And that is subject to debate. And in the Netherlands, as of the 1st of January, there's a sort of public register, a topic of many bachelor theses. Because the idea is that when such a register is public, then we can control money laundering better and stuff like that. And that register is obviously subject to technological innovation. So that is in most jurisdictions electronically. And the moment shares are traded on a public stock market, the keeping track of who is shareholder is sort of outsourced to agents within that stock market, because that register is changing with the speed of light every minute, 24/7, 365 days a year, you know, with the app, the stock market app. And you can become an owner, and 2 hours later you can sell it again. And so somewhere this conceptual thing, shareholder register, is cleverly arranged at a certain point. Those are the three quick and dirty ingredients. Question?
So it's not mandatory under law to publish your shareholder register?
In most jurisdictions, not. And even when the name of the legal entity is called a public entity, that is not necessarily the same that the whole register is public. I remind you, the world record initial public offering ever, last week, ladies and gentlemen, of the Saudi oil company Aramco, which is by now officially the most valuable company on the globe, twice as valuable as Apple. So not 1 trillion, but $2 trillion. But here's the snap. They only sold 1.5% of its shares in New York. So 98 plus something shares percent are still owned by the King of Saudi Arabia. So don't fool yourself with initial public offering that all of a sudden a company is a public company. 1.5% of all the shares is public, the rest not. Footnote: who sold or who purchased these shares, according to Reuters, that type of sources? Friendly investors. So, you know, the Sheikh of Abu Dhabi and Dubai, so they bought it. I guess they got a phone call from the King of Saudi Arabia. Please buy my shares. So that the value rating agencies can calculate the total value on the basis of a few shares times 100% and making up this funny number 2 trillion. Where 2 trillion? And so talking about whether a shareholder register is public. And that is mostly stock market rules that triggers that, and national rules, because national rules are sort of covering up-ish. Like, okay, for certain purposes it's public, but there's a difference between stakeholders with due diligence interest and the general public. Well, just to prove that my statements have some basis in the law, this is just Article 101 in Chapter 8 of the Delaware legislative package, with titles like How Corporations Are Formed. And it says, any person may incorporate or organize a corporation under this chapter by filing with the Division of Corporation in the Department of State a certificate of incorporation. So here the synonym of the Establishing Act is called a certificate. So you type the certificate and you file it, and then boom, you exist. Or in the Netherlands, Article 64 of Book 2, Civil Code, the corporation is formed by one or more persons by means of a notarial deed. It's the same mechanism, you know, someone who types language like herewith we establish shall incorporated, and you register it. And this is an example out of the Delaware jurisdiction. The undersigned, a natural person, defined as the sole incorporator, so the founder has many synonyms, including but not limited to incorporator, for the purpose of organizing a corporation to conduct business and promote the purpose herein after stated, under the provisions and subject to the requirements of the laws of the state of Delaware, hereby certifies